Well, Asian markets have recovered, and that's despite growing concern over tensions in the Middle East and US President Joe Biden's visit to Israel, as we've been discussing. Japan's Nikkei 225 rebounded, gaining 0.98%, while the Topix advanced 0.57%. Now, South Korea's Kospi rose 1%, and Hong Kong's Seng index gained 0.75%, reversing yesterday's decline. Gold prices, well, they have risen since the start of the war, with the safe haven asset holding firm above $1,900 per ounce. And investors remain in a wait-and-see mode as the events in the Middle East continue to unfold. Well, for more on this, let's bring in Neil Wilson, Chief Market Analyst at Finalto. Welcome to the programme. So talk us through how increasing tensions in the Middle East are affecting markets right now.
Yeah, well, I think what you saw last week was a bit of a kind of muddied picture, really. I think, there is a sort of sense that this could escalate, but there's not a very good sense of it escalating. So what we're seeing is, and it happens quite a lot, is just how bad investors and traders are at pricing in geopolitical risk into the markets. So it always becomes a bit muddied. You see oil tend to move high. You see gold catching some attention. You see government bonds, which are seen as safer havens, they get some a bid as well. So we have seen that playing out. We've since seen something of an unwind of that haven bid, particularly on Friday afternoon, as we thought perhaps that maybe investors were not so keen to hold on to some of the riskier assets over the weekend, with a lot of uncertainty about how this plays out. And then, yesterday and into today, we've seen a bit more positivity returning into markets. So equities picking up some bid again. So I think what generally you see is, investors seek out a bit of safety. So they look at gold, they look at the US dollar, they look at treasury bonds. But longer term, no one really knows how this plays out, and investors don't tend to be very good at pricing in these risks. So you do see some volatility and some sort of muddy kind of picture in the markets.
And that US President Joe Biden is visiting the region on Wednesday. What signals are investors expecting from that visit?
Well, I think, the US is obviously going to be saying that it's standing foursquare behind Israel, but it's trying to seek out some other diplomatic solutions at the same time. I think, what the market will want to see is really that sense that there's not going to be escalation, that there's not further actors on the scene. And that will be the key thing. I think as part of that, it may be, what sort of message is the US sending to the Israeli government about how they conduct the next phase of the operation, because the sort of law of unintended consequences starts to play out, and we see that if Israel does one thing, then maybe some other actors come in and do something else. So I think investors want stability, they want certainty, and that's just kind of what we don't have right now. So it'd be difficult for the president to really do an awful lot to assuage market fears, but that's nonetheless what investors will be hoping for.
Neil, let's speak about oil. It's retreated after a recent spike, but we are still seeing benchmarks holding around $90 a barrel. What's the current investor sentiment on oil like?
Well, this geopolitical risk premium that we've seen, that's a factor. That doesn't tend to last too long for oil. It lasts maybe a few days, few weeks, whatever, but it doesn't tend to last that long. We have seen speculators just trimming their long positions, so they've just become a little bit less bullish on oil as it has approached $100 and then retreated. I think the big question for oil really is on that demand side. So I think supply looks well contained. Looks like OPEC and Russia have a pretty strong handle on supply. Maybe there's some movement from Venezuela, the US looking to ease restrictions there. But the key question is on demand, and I think the market is looking at maybe demand holding up for now. So it's quite tight at the moment. Physical market remains tight. But looking ahead into next year, question marks over whether or not we head into a global recession and lower demand.